All right, all right, all right. How you doing, everybody? It's good to see you. Glad to have such a nice group here with us this morning. And we started a new class down at the university, and so this is the lab for that class. And anybody who's coming to us here from just the wild, wild west of the YouTube channel, welcome. You're welcome too. But this is going to be focused primarily on what we learned last night at the university in our class. And so that is what we're doing today. And so I'm happy to have you guys all here. And first thing I want to do is I just want to get started very quickly and pull up our slides from last night and talk a little bit about some of the things that we talked about last night, just to review. And then we're going to look at some charts because that's what we missed last night. And we're down at the university, markets are closed. So generally we do the academic work down there and we study and we learn. We talk about different strategies, and then we come out here to the YouTubes, and this is where we get to actually practice what we preach. All right, so this is the, let's see, if we go over to our class, this is where we had the economic calendar. Remember the economic calendar? I said it's our economic calendar that usually moves the market, not MSNBC headlines. It's the moves in the markets that create the headlines, not the other way around. All right. So they only tell you what happened in the past. They're not very good at telling you what happens, what's going to happen in the future. So we use economic calendars for that. And again, remember, we have the fundamental nature of markets. We have the technical side of markets. Fundamentals drive the long-term trends. Those are what we want to look for, opportunities for us to see rising or falling markets. And then the setups and triggers, the things that get us into the market, the timing for entry into those fundamental trends is we use technical analysis. All right. And technical analysis, we're going to get into that into greater detail on Wednesday night, some of the setups and triggers. So look forward to that. And can't teach it all to you in one night. So what we did last night is we looked at the base structure or the foundation of our trading. So I'm going to skip down through some of this stuff. And this is what we're going to talk about today. All right. So we'll talk about the Kona probability, and we're going to talk about the Wyckoff models. All right. So the economic calendar, though, let's switch over here, and this is the economic calendar. So this is the one I like. And again, like I said last night, there's like 10,000 of them out there on the internet. You can go find one you like. This is the one I like. If you find a better one than this, let me know so I can switch over to that one, because I have no connection with these guys. It's just something this is the kind of the one I like. And so it's called Trading Economics, tradingeconomics.com/calendar. You can see it right up there. That's the URL. Okay. So tradingeconomics.com/calendar. And that brings you here to this page. And they've put ads at the top because that's how they pay for it. So you get to have little ads. But then we come in here and you got some settings. These are just the setting buttons. And I like to come in here and I like to just use 2, and that gives you 3. You don't have to collect both of them. If you click this one, then it only gives you 3. If you do this one, it gives you 2s and 3s. If you click this one, it gives you all 1s, 2s, and 3s. So I just do this one. I like 2s, not so interested in the 1s. And then it will go down and it's just a calendar. And then it gives you the ones that are the highest probability of moving the market. And then you got all the countries. You can go in and look at this, and we just clear all the countries. And the only ones I'm interested in is just the United States right down here. And so we go back there, and then we go into categories, and I just say all events, all categories. And then we go UTC, and you have to make sure you're on the right UTC. We're on UTC 7 right now. And so we want to make sure that that's correct so that we're, are we on UTC 7? Because I get that wrong sometimes. And we just had let's double check. How are we going to check what UTC we're in? Let's just ask Grok. I'm in Utah today. What's my UTC time? I think we're 7. UTC Utah right now, UTC 16.05. That's 7 hours. So we're UTC 7. All right. So that's how we find out for sure, and that's UTC 7. So we just drop this down, UTC 7, and away we go. Now these times will line up with my times on my clock. So AP crude oil, that's the only thing we got left at 9:50. Oh, 9:55, we've got Fed Kashkari is speaking. And at 7:55, we had Fed Williams speak. So those guys, they have a tendency to move the market. They say things, and then the markets like to bounce around a little bit after them. And then, of course, we got crude oil coming in. That's going to be at 2:30 this afternoon. We're going to go look at the crude oil chart here in just a second, just for fun. And then we got Wednesday. We've got which is tomorrow. We got 5 a.m. We got 6. Look at this one. We got an 8 o'clock ISM Services PMI. So that's the Purchasing Managers Index, and that one moves the market. See, it's 8 o'clock. So 8 o'clock in the morning, they're going to release that news report, and that's going to affect the markets. So we can go in and prepare for that. And then we got more crude oil coming in, gasoline stocks here in the afternoon tomorrow. And then we can see for Thursday, we got exports month over month, imports month over month. We got jobless claims. That'll be a good one. That usually moves the market. Forecast is 215. The consensus is 215. The previous was 212. So they're saying job losses are going up. So that's what that's saying. Initial jobless claims. They're anticipating going from 212 to 215. We got non-farm productivity. That's a good one. That'll move the markets. So forecast is 4. The consensus is 1.9. The previous 1. So those are some big spreads. So that'll be a market mover right there. Unit labor cost quarter over quarter. So we've got another pretty good size spread. So that'll move the market as well. But that's 6:30 in the morning. So those things are going to come up. All this is at 6:30. So that'll be make for a crazy opening bell. And then Friday, we have the non-farm payroll, again at 6:30. That's a big one. Retail sales, another big one. Unemployment. So Friday, the markets are going to open up and go absolutely nuts first thing in the morning. So be prepared for that. Average hourly earnings, they're coming in at 6:30, 6:30. All these are at 6:30. Oh, we got a lot of stuff coming at 6:30 on Friday. Friday's going to be a nutso day. All right. If you're a day trader, it might be a good day to day trade. And then we got business inventories coming in at 8 o'clock. And then Fed Hammock speaks at 11:30. And then this is going into next week. You can see it goes out quite a ways because we know in these calendars when these events are going to happen. So you can see that those are going to be newsworthy events or fundamental. These would be considered fundamental, right? Fundamental news. And so then we would use our technical analysis, and we're going to go look a little bit at that today, and then we'll get into greater detail into the setups and triggers on Wednesday. All right, so that's what we're looking at right now. So let's jump over to the charts. And I want to pull up. I want to see. I wanted to just show you that this is the manual. For those of you who didn't get the manual, remember the manual is right here. This is what the manual looks like. So you can see the manual, and then of course we've got. We got more slides coming, but we'll talk about these slides on Wednesday. All right, so I think that's where we got to today. That's what we need to talk about. Now let's go over and look at crude oil just for fun. I wanted to show you SFO magazine. This is our magazine. So here's the cover. This is this month's magazine, and we talked about it being a new layout. So we're kind of excited about that. We got lots of different fun, wonderful articles in the magazine for us. And then, of course, everything is recorded. So all you have to do is just click this, and you can listen to the article. You don't have to actually read. All right. But of course, you got all of the words there. So if you want to reference back to it and say, oh my gosh, that was a really good idea, I want to know how to do that, you got all the written word. You can come back and go through it. All right. So we got lots of fun articles. Claire wrote an article. She grew up on a ranch. So she's talking about trading pigs and cattle, and she's going to take you through that. Her venture trading pigs and cattle on the futures market. Then we got Aiden Gray. He wrote an article on the 112 put option ratio spread. And then the recalibration month. This is the seasonal nature of the markets. We've got some trade recommendations in here for seasonal trades. And then we got a SWOT report on Excel Energy. All kinds of fun things that we talked about. Of course, you got your fun stuff. And so that's the nature of the beast right there. And let's go over now and jump in and look at crude oil. All right, what's going on over in overseas? Crazy things are going on overseas, right? We got a war going on. And of course, they're bomb Iran. So here we go. This is what happened to crude oil. And this is the USO ETF, Exchange Traded Fund. And so this is what's happening to the price of crude oil right now. Everybody wants to buy crude today. You want to buy crude oil today? It's already made a massive run. Does it mean it can't go higher? No, it certainly can. But if you're going to buy it today, you better be darn well ready to defend your position, because it could come flushing right back down too, right? We don't know. Nobody knows how high this is going to go. Nobody knows how far it's going to come back. But that's kind of what happened. If you were anticipating that the crude oil would have gone up in price when the war started, you could have bought some crude oil down here and rode that baby up. All right, so that's the nature of the beast, right? Using fundamental events in the markets to help us profit in our trading. And so the setups and the triggers for this is what we want to talk about today and what we're learning about in these classes. So this is the Dow over here. Let me show you just real quick. This is the software I use. So if you guys want to follow along with me and the software that I use.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, don't go download it right now. Wait till the class is over, and then you go download it, and we'll have another lab tomorrow, and then we'll work on actually tomorrow we're going to do the futures version. So that's the version we're going to use tomorrow for day trading, because it's much better for day trading if you want to day trade. In fact, I got it pulled up here. Let's go look at crude oil on the day trading platform. So this is the day trading platform. This is Track and Trade again, and it's the software we use to day trade in, and it's out of Chicago, like we talked about last night, right? Chicago, the Bulls and Bears. And so this is a 1-minute chart. So each one of these price bars represents 1 minute time frame. And so you could day trade this if you want. This is that same chart. So this is the crude oil. Now this is the micro. So from, let's just say from this top of this trend to this trend, you can tell that's $191. And that started at 7 o'clock this morning and went until 7:20. So that's 20 price bars. That's 20 minutes. Okay, so over a 20-minute time, if you'd have bought right down here and sold right up there, that would have been $193 in profit trading crude oil. So that would have been a day trade, short little 20-minute day trade, right? So that's what you do. You sit here and you say, well, when do I think the market's going to go make a nice little run like that? So you can either, get in or stay out or whatever you want. And we use setups and triggers. We use these little arrows, and we use some of these little lines on the screen. We use some of these little indicators down here at the bottom to help us make decisions on when we want to get in and out of the market. All right, so that's day trading. That's all there is to it. You come over here to your trading tab. You got your buys, your sells. You got some quick OCOs. These are programmable buttons to make it a lot easier on you. That's why we use a trading platform. All of your money is in your account right here. You get a demo account. You get free. I think they give you like $500,000 so that you can just spend to your heart's content and try every little strategy you want, so you can practice. And then when you are ready to do it with real money, you just flip the little button right up here and go from demo into live, and it'll flip right over right here. You go in to open a real money account, and you can go right into your real money account and trade, do the exact same thing in the exact same platform with real money. And then it manages your account. You got your whole accounting system down here. So all of your accounts, your open positions, your closed positions, you got your options down here. Even have an autopilot in case you want to do some back testing on your option or on your trading strategy. But this is where your accounting is. It's all down here. And then this is where you switch over to different time frames. Really easy, really fun, really good platform for trading. All right. So this is the one I use. And if you want my help, I can help you. All right. So that's why I'm here. I'm here to help you. All right. So that's the name of the game. That's the nature of the beast. And that's if we wanted to take a little trade in here, we could do that. But we'll do that tomorrow afternoon at 1 o'clock. We'll come in here. Maybe we'll trade crude oil tomorrow afternoon. How does that sound? So I'm going to go ahead and close this right now. I just wanted to show you that that's how we get started in the futures market doing day trading. So we'll do that tomorrow afternoon. Save changes? Yeah, we'll save those changes. All right, so this is back to the stock market version. Again, Track and Trade here in the stock market version. And we're going to go through and we're going to look at the fundamental nature of the markets. And I've got pulled up in here, I've created beforehand in the interest of time, but I'll show you how I did it. Actually, you probably want to see how I did that. Let's come in here. I have the Dow 30. And I'm going to come in and I'm going to show you how I did this. I used Gemini. All right, Gemini is Google's AI system. And I'm going to pull that over here onto the screen so you can see what I did. And we'll come over here. And I did this one right here, Dow 30. So you can see all I did is I said, it kind of got a little confused here at the first. It says, can you give me a CSV file of the 30 tickers in the Dow 30? All right. So it came in here and it said, so the Dow 30 is a ETF, exchange traded fund. It's considered one of our indexes, and it's got 30 stocks in it. So when you're driving down the driving down the road and you always hear it on the radio? The Dow is up, the Dow is down, right? The Dow is up, the Dow is down. Okay, so you hear the intonation of my voice. The Dow is down. Oh, that to us, right? We know it's funny. I'll tell you a funny story. My wife is Filipino, and English. She's English second language, right? So she speaks Filipino, but she also speaks English. And around my house, you know how we have a lot of in the English language, we have a lot of intonation that gives us ways that we know whether something's good or bad, or that means yes, or that means no. All right, you guys all know that. If I was to come to you and you say, hey, you want some breakfast, and you go or you want some eggs for breakfast, that would mean yes, right? Well, that doesn't work very good when you're married to a Filipino. She asked me the other day, she goes, would you like some bacon and eggs for breakfast? I said She turned and walked away, and I was like, wait a second, where's my bacon and eggs? That doesn't mean anything to her. I just made a noise. She didn't know what that means. So the Dow is up. That's positive. The Dow is down. That's negative, right? We got intonation in our voice that makes that occur. And so the Dow is down. That's bad. The Dow is up. That's good. All right. Unless you make money on the markets going down, you could do that, right? And the reason I bring that up is because generally speaking, we like to see the markets go up. You can still make money when markets go down. And so you could say the market is down, and then you would say the market is down. You have to use the opposing intonation, right? So I came in here anyway, back to Gemini. Gemini, I asked it, can you give me the CSV tickers for the Dow 30? And here it gave them to me. And I said, oh, no, that's not what I want. I don't want to export the sheet. So I said, CSV, you can copy this block into a CSV file. Well, I don't want that because I didn't want all the names. So I said, I need it in a CSV format, comma separated. And so then it did this for me again. I'm like, oh, that's not what I want. And then I said, just the tickers, no names, one right after the other, separated by commas. Finally gave me the right list. So here I copy that list out just like that. Hit Control C, so that hit copy, right? Just in Windows, if you hit Control C, that copies. You could also right click on it and say copy. That works too. And then you come over to Track and Trade, and you type right in here, and you just say, you put your cursor right in there, and you say Control V as in Victor. And of course, that means paste. Now you can right click in there and hit paste as well. Either one works. You hit paste, and notice that it puts all those tickers that we just copied out of Gemini right here. And Google will do it. I mean, not Google won't do it, but Gemini is Google, but Gemini is there. But Grok will do it. ChatGPT will do it. Claude will do it. Any of those AI systems will do that for you. And you can do that with any group. You can say the S&P 500. Of course, you can't put 500 tickers into one little portfolio and poor little Track and Trade choke on it. I think it's got a limit of 100. So you'd have to break it down. So we come in here and we put those 30 stocks in there, and we hit open symbol, and boom, and it opens up each one of those symbols. Now it's already got them open because I already did it. But so it's going to rotate through each one of those Dow 30s, opening them all up, but they're all open. So it's just going to rotate through them. All right. And that's how you create a portfolio in Track and Trade, and you can come through, and it's really nice that way. And then you can hit save. You hit your little floppy disk up here. People nowadays don't even know what a floppy disk is. It's funny that we still use that as our save button. So I hit save, and that's going to save your file. And then next time you open up your Track and Trade, you can open up that book, which is just like think of Track and Trade as like Microsoft Word. So we save a book or a file, and inside that file, we have all of our little portfolios. So I got look at this. There's a whole bunch of portfolios that I've got in one book. So I open up that book, and then it loads all these portfolios. So I can close this book out, create a whole new book, start a whole new set of portfolios. And each one of these portfolios has all of my stuff in it. So there's my Dow 30. So that's just one portfolio inside of my overall longer term book. And I probably got too many things for this book. It's probably getting way too big. I probably don't need to have all that stuff in one book. You can have just one book of something if you want to, but I like to just keep it like this. And then up here on the file side, you can tell it to remember your last book. And so if you select that, then every time you open the software, it's just going to automatically open up that last book, which has all of my portfolios in it. Okay, so I got all these little portfolios. These are just saved files is really what that means. So this is our Dow 30. Now, what we want to do is we're going to go through and we're just going to analyze these from the standpoint of what we looked at last time. Now, I said we were going to go through and do the Mag 7. I was going to do the Mag 7, but we've done the Mag 7 in this class so many times. I'm going to switch it up a little bit if you don't mind. We're going to go do the Dow 30 instead. And I'm going to skip some of the bigger markets like Apple, because we did Apple last time we were in class. Now, I know you guys are new class, but we've got some other option stuff on here that's in play for our other class. And so I don't want to kind of mess with that right now, because we got, see, like American Express, we got some option strategies in here showing how this works to protect yourself against a falling market. Again, it's beyond the scope of this class. We'll cover this kind of stuff in the options class in 2 weeks. This week, not next week, the following week. So we're going to skip that for now. We're going to go to one that doesn't have anything on it. Now, I want to come in and I want to turn off some of this stuff. This is what most people look at when you see a chart. All right. Most traders, this is kind of a typical chart for most traders. We're not most traders. All right. We're much smarter than the average bear. And so we use tools to help us read the market a little more cleanly. And so these are the indicators that we like to use. And one of the indicators I like to use is called the Fibonacci bars. All right. You can write all these things down and go do a little study on them yourself. But the Fibonacci bars in Track and Trade are right here. Now, they don't show up right there when you first open the box. It's software. I kind of customized my software, so it looks a little bit different than what yours might look like coming out of the box. But if you want my help to help you set it up, we can do a setup video, or we can come and do a class where all we do is set up the Track and Trade software. I'll show you all my settings. But I kind of do my settings along the way as we teach the class. So I'm going to show you right now. You'll notice that just like any Windows program, they got little handles on their toolbars, so you can move the toolbars around. All right. So we're going to redock the toolbar. Come on. There we go. And it's got a little handle. If you right click on that handle, you can customize the toolbar, and it pulls up this little window like this. And then you can slide down on this side. These are the available tools. And then these are the tools that are in that toolbar. And so that's the ones that are in there. Now, to get the little HA, to get the Fibonacci, because it doesn't come like that out of the box, you have to come over here and you have to slide down here, find it in the list. Now, I've already got it, of course, but you click on it and then say add, and it'll move it over into this box, which means it's now in your box up here. All right, so I'm going to hit close on this because mine's already there. There it is. So you click on little HA up there, Fibonacci, and look what it does to the price bars. And that's pretty cool, right? So if we turn it off, this is what most people look like. This is what most charts look like for people. Turn it on, boom. That's with Fibonacci. Now, Fibonacci is, in my opinion, is kind of like the cheat codes. I like those. That kind of puts a little averaging system into the bars themselves. So it's an indicator, but it changes the price bars. So it makes it easier for us to see the trends of the market. So that's a nice trending market. That's Amgen. And so another tool that we're going to do, we're going to come in here and I like to see what we call average true range. All right, the ATR. So we right click on the chart again with Track and Trade. The way you do that is you slide down here to chart overlays, and we come down to ATR. It's just one of the indicators in here. We're going to talk more about indicators in class on Wednesday, but we do a lot of indicator work here in this class. That's why we're here. So we come in here and we're going to go to ATR. Now, if you're using another platform, if you don't have a trading platform, I recommend this one. If you already have a trading platform, let's say you're with a broker and they give you a free platform. This platform is not free. This is kind of like the Ferrari of retail trading platforms. If you want the Ferrari of retail trading platforms, this is a great one. All right. There's lots of trading platforms out there. Some are free. They're usually worth what you pay for them. All right. So your broker will sometimes give you a charting program, but there's very subtle changes on many things, and sometimes you get what you pay for. So this is just a nice platform. I like this, is the one I use, but the point I'm trying to make is that if you want to use ATR and you want to use Fibonacci, you're going to have to make those adjustments on your trading platform if you want to kind of use the same strategies that I use. So I'm here to teach you how to use the strategies, whatever trading platform I'm using. I can't do all 400 platforms that are out there in the world and show you how to do it in all 400 platforms. So whatever platform you have, you're going to have to kind of figure it out on your own. If you use the same one I'm using, then I can show you. All right. So we come in here and we hit ATR. An ATR is an average true range indicator that lays over the top of the chart, and it's what's giving us these little dots in here. All right. Now, if we come down here to ATR, you can see average true range. We have ATR period of 1. This is my settings, so take your little camera and go over there and pull up your little camera and take a picture of my settings so you can put it into your software. And so I like ATR period of 1. Now, that's not how it comes out of the box. If you hit T&T defaults, you'll notice this is what it looks like coming out of the box. All right, that's the standard settings. But I don't use the standard settings, not very often. Not that I don't. Sometimes I do. But the ones I like are a little bit tighter for a little bit shorter trades. All right, a little bit shorter trades. So I have my settings. So I go up here to my defaults and I set them to 1 and 1. And that's where I kind of like to start because I like to do the little ABC patterns. So we talked about the little ABC patterns last night. This is A, B, C, D, right? A, B, C, D. Very, very simple, very easy. And so I like this little yellow dots because that will show me the first line up, the second line down. Those are areas of support across the bottom, resistance across the top, and support across the bottom. So that ends up being a trend line, and that is your mathematically calculated trend line is what those little yellow dots end up being. So we have the rally, which is the uptrend. We have the counter trend, which is the downtrend. We have the uptrend, which is the next uptrend. So that's A, B, C, D. So I'm going to come in here and grab the ABCD tool, which is right here. And we just go A, B, C, and then it projects D. See how that works? It's a little tool that we use in the software. It's a very unique tool. And we have, it's based on a mathematical modeling. And we're going to come in and we're going to use that little tool all the time. So we can go A, B, C, and then it projects where the market's going to go. And sometimes you'll be so surprised how this little mathematical model, we're going to talk about this in greater detail on Wednesday night, how this little mathematical model works, but it's based on Fibonacci. And so it is a Fibonacci tool that projects market movements, and it's in track and trade. It's a neat little tool. And if you've got track and trade, I'm going to show you my settings. Again, let's get rid of the accounting window. We don't need that anymore. Take your camera, pull out your little camera and take a picture of these settings, because this is how I use this tool, and it doesn't come out of the box like this. These are my custom settings. I'm in the way. Hold on a second. Let me get out of the way. All right, I'm out of the way. So there you go. Take a picture of that screen right there, because you're going to want to put that screen into your software to do what I'm doing here today. All right, give you a second to take your picture. That's a great little tool. Now, those are in the Preferences tab. So all the tools, all the indicators, everything that we use in the software has settings up there in the Preferences tab. So you just click on the Preferences tab, and then any tool that you open up, the preferences will pop up on the screen right there. And then you want to set your preferences to look like mine. All right, so I'm going to assume everybody's got their pictures. So we'll go back down here. We'll go back over to the charts. Okay, so that's just a little bit of an insight of what we're going to be doing on Wednesday. So come and learn that. We're going to have a lot of fun with that tool. And then we're going to come in, and now what we need to do is we need to start looking at different models. All right, so we're going to pull up the accumulation distribution model. And remember last night we pulled this up, and we talked about this right here. And we're going to go into it in greater detail on Wednesday night. We're going to learn a little bit more about this model. Just kind of introduced you to it. So I want you to take a look at markets and kind of figure out where we're at in this map of the markets. Okay. So it looks like in here, this is the lowest point. So if we were to lay that over the top of this market, you kind of just have this little map, but you can see this accumulation stage. Obviously, in hindsight, it's easy to see. It's not so easy to see as the markets are moving forward, but we have this little accumulation area right in here. And as the market starts to move forward, you see the little pullbacks in there. You see the rally up in here, the little pullback. We're getting one more pullback up in here, looking kind of like this topping up in here. You see how you can kind of use it as a guide? Now, it's not going to be perfect. Sometimes it is. Sometimes you look at this thing and you're like, oh my gosh, it is absolutely exactly like the drawing. And we'll go show you some of the other charts. But it's kind of just a map. It's a guide. This was drawn 50 years ago. So take that into consideration. But it works over and over and over again. So right up in here, we're getting up into what we call the delta cone of probability on the third drive pattern. So we got drive 1, drive 2, drive 3. And so that's the cone of probability, right? Remember, we talked about that last night. So if I pull up our, where is our, I thought I had my cone of probability right here. Oh, man, I thought I had it right here on my desktop. So I could just grab it and pull it up for you easy. Looks like we're going to have to pull it up this way. All right, so the cone of probability, did I just pass it? Yeah, there it is right there. Remember the delta cone of probability, approximately 68.2% of the market stays within one standard deviation. Now we have to keep counting these standard deviations because they're fractal. Remember, fractal meaning, of course, that things work on smaller scales and larger scales. So each one of these can be a little fractal move or a little delta cone, and then overall the whole thing can be one delta cone. So we got to look at stuff from different standpoints. So on this market here, we're getting up into the third delta cone of probability. Now there's a tool that we use to measure this. All right, there's a tool that we use, come on, to measure this. See that? From top to bottom, 3 standard deviations to 3 standard deviations. But we got a tool that'll measure each one of these standard deviations, and it's called the Fibonacci ruler. And again, we're going to learn more about the Fibonacci ruler on Wednesday night, but I'm going to show you it right here. I meant to get to it on Monday night, but we ran long. All right, so there's your delta cone of probability tool. It's called the Fibonacci ruler. So if you want to imagine, let's see if we can imagine in our brains, this is the delta cone of probability like this. All right, like I have it drawn. Remember, it's just a bell curve that I've turned sideways so that we can see it in reference to the markets that go this way across our screen. Okay, so as they go up and down, they're going through the delta cone of probability. And so I want you to see right here that the market started at the bottom, and we measured from the top to the bottom, and then it pulled back, just like it says, 68.2% of the time. 68.2% of the time, if it goes from this point to this point, it's going to come back to this point. Okay, or back close to it somewhere. So that's what we're measuring. So we remember our mantra: count, measure, set up, trigger, and follow through. So we're going to count the drives. How many drives do we get? Well, we got one here that went up from this point to this point, and it came back. And it came back where? Right into the delta cone of probability, right into what I call the Fibonacci sweet spot, between 38.2, 50, and 61.8. You could almost turn off that 50% right there and just use between 38.2 and 61.8. Those are our Fibonacci numbers. And so if we come into our preferences, we could even do that right here just to show you how you could do it. You could turn off the Fibonacci 50. There we go. Turn it off. There you go. We don't need it. Right? Let's save, update all Fibonacci rulers. So that's our delta cone of probability is right there, dead center. It kind of doesn't look right without it though. So let's turn it back on. Just showing you can do stuff like that. All right, so we can turn that on. So now we got our 50%. We'll save that as my defaults, update all. Okay, so we're back to having our 50%, but that's the delta cone of probability, and that's what we're looking for. So now we get a pullback. The market starts to rally once again. It breaks our little yellow dots right there. And so that is the next bottom of the next delta cone. So we start right there, and we drag it up to the top of this delta cone. There it is. And then look what happened. Market went up through the delta cone of probability, came back down, just like a train on rails, right back into the one standard deviation. All right, so the market goes up, comes back down. Now it's going to do it again. So we're going to take the delta cone of probability tool, and we're going to measure from the bottom all the way up to the very top. And it's right up here. Let's go all the way up here to this one. And you can see right there. And usually these little, we got several tools that'll help us count them. But see where the little yellow dots broke? The little yellow dots broke. That's how you know which side you're counting. So it went here, and the little yellow dots didn't break right here. So we go up even higher. Wait until the little yellow dots break and flip to the other side. Then that's the market telling you. See, remember, Wyckoff said the market tells you what to do. And this is how it tells you. It tells you what to do. So we're right up here at the top of the B drive. So we go from A to B. This is one more delta cone of probability that we're measuring. We could measure it from right here where this little break is if you want to. That's okay too. Well, let's get rid of that. Do you move your little corner up there to that one? Right there. See where it broke those yellow dots? And then that one yellow dot went up there. So that's our new measurement. And our delta cone of probability is going to be between 38.2 and 61.8. So we'll expect that market to come back down into that region. Does it mean it has to? No, it doesn't have to. It's just probabilities. It's just probabilities. But that's going up into the third delta cone of the overall longer term run, right? So approximately 68.2% of the time, it goes up and it comes back down to this region here. And that's what we've been measuring. And and the first two it did, right? The first two, it came right back down into our delta cone of probability. And then we have around 95.4% of the time it falls within 2 standard deviations, and nearly 99.7 falls within 3 standard deviations. So where do we get that? How do we measure that? Well, if we come in here, we got the 1 standard deviation, the 2 standard deviations, the 3 standard deviations. Now we're measuring each one individually, each one of the standard deviations by itself, but we can also measure the entire standard deviation of all 3 combined. So there, now from the bottom up, the first one, the second one, the third one. So this is the first standard deviation. We call it drive 1. This is the second standard deviation. It's drive 2. This is the third standard deviation, drive 3. Now, just because it's at the top of the third standard deviation doesn't mean it can't turn and go up and make a fourth. Doesn't mean it can't turn and go up and make a fifth, a sixth, a seventh. Keep making higher and higher standard deviations. It certainly can. It's just that the probabilities of that happening are next to nothing. And you get down to a 99.7% chance it's going to go higher than the third standard deviation. That's not a very good bet I'm willing to take. So us as small speculators, we don't do that. We don't try and buy into a market at the top of the third drive, because that's the top of that's 99. That's a 99.7% chance that you're going to lose money if you buy it up there. That's not a good bet. If you went to Las Vegas and sat down at a roulette wheel table and they told you that you had a 99.7% chance of losing money playing that game, would you sit down at that table and start playing that game? No, but people do it all the time. People do it in the stock market all the time. They'll buy at the top of a third standard deviation where they have a 99.7% chance of losing money, and they'll buy right there all the time. Okay? And as the market starts to approach that 99.7% of the time, they'll start buying right in here. They'll start buying right in here. Look at that. This is your perfect little drive up. Okay? Let's get rid of these little arrows. Let me show you. Delete all arrows. Let me get rid of this. Let's bring up our map again. Look at our map. I just grabbed the first one out of the list. I skipped Apple because I didn't want to do one of the Mag 7. I went right to the next one, Amgen. I didn't cherry pick this. I just picked it as the first one in the list that wasn't Apple. All right, so we're going to come in here and we're going to look at our model again. Look at this. Look at this model. Come on, shrink for me. That Apple, that Microsoft little tool that's supposed to shrink our charts doesn't work very good. All right, see this? This is just this one piece right here. Let's bring this back up. We're just going to measure this one standard deviation. I want to show you. This thing happens over and over and over again. Look right there. This is drive 1, counter trend. Drive 2, counter trend. Drive 3, we're at the top. So every little one of these drives can have inside of it, that's called fractal, could have another little miniature 3-drive pattern. Drive 1, counter trend. Drive 2, counter trend. Drive 3. Not just from the bottom of the all 3 drives, which it does all 3. Drive 1, counter trend. Drive 2, counter trend. Drive 3. Now we expect it to come all the way back down to the big one. If we're measuring the big one, that's where we expect, because it's already gone and done 3. It's done 3 up. Now we'll probably expect it to come all the way back down here. So I don't want to be a buyer up there. It's not a good place. Don't buy high and try and sell higher, or buy high and never sell until you falls all the way back down here, and then you lose all your money because you sell down there. So don't do that. All right. So that's that one. That's Amgen. So what do we expect it to do coming down the other side? Well, if we look at our model, if we look at our little model right here, we would expect Amgen to make this kind of a pattern coming back down, right? And so that's what we would anticipate. It's gone up 3 drives. Now we'll expect it to come down, come up off of this. You can see right there, the spring. See how the top was right here, and that got everybody thinking that was the top. And then what'd they do? They popped it one more time right there to give you the spring. Oh, we're going to go higher. And everybody jumps on and then flush. They flush the market out from under them and take all their money. Now the market's going to come down. It'll probably go through some sort of a little jig and a jog like this. And then it'll come down here and go through a little jig and a jog like this. And then it'll probably start to do something where it'll turn around and start to go back up again. Because that's what the model says if we're in a bullish market. Now, if we're in a bearish market, right, we might go the other way. We might, let's pull up this one here. We'll go with a bearish market. We might get one that looks more like this, right? And it'll come down a little bit further. Come down, go through the little sideways thing through the middle, and then it'll drop out the bottom and come all the way back down and maybe start going. That's the one where we have to be careful because we go into a bear market where it comes down, it matches this bottom down here rather than just at the cone of probability, where this is where we'd expect it to go back up in a bullish market. But if it comes down here, breaks this, comes down here and starts to go sideways, well, then we have to watch. It might go back up, but it could start doing its accumulation for another downside draw and we go into a bear market. All right, that's how that works. So let's go over to the next one. Let's look at Amazon. Oh my goodness, Amazon. You're like, well, Amazon's not doing that. You're right, it's not. It's got some natural trend lines in here that we can look at. It's got some 3 drive patterns. There's a drive 1, drive 2, drive 3. So a nice little 3 drive pattern, but that's ugly. Whew, Amazon got ugly right there. And so we can come in here and we can look back in time. And interestingly enough, right there, just in the last Darvas box, remember we call each one of these sets a Darvas box. The last Darvas box Amazon's going through, not very pretty. Agreed. All right. Doesn't always look perfect. But this one looks a heck of a lot nicer, doesn't it? Well, it actually looks more like this one, doesn't it? We pull this one up. This Amazon drive looks like it came all the way back down to the beginning, just like this one. So it's a bit more of a bearish move, but it did turn and start to go back up out of there, just like that. Okay, but that's pretty much right straight out of the manual. So this is your accumulation stage right here. You got your move up through the drives. You got there's drive 1, drive 2, drive 3. It gave us 4 drives. So this is the accumulation stage. We oftentimes don't count the accumulation stage as the first drive. So that blue right there, this is all accumulation. So it's drive 1, drive 2, drive 3. And then it flushed A, B, C, and it went all the way back down to this bottom point right there, just like a train on rails. All right, so this is the accumulation stage. Like I said, we don't generally count the accumulation stage as drive 1. So that's the accumulation stage. You can see the spring right there. They sprung it down to make everything it was going to go down one more time. Sell out all your shares because you're scared to death. And then that's when they bring it back up. And then the market comes in here, and then you have drive 1, counter trend, drive 2, counter trend, drive 3, and down it flushed. So if we take let's get rid of all this stuff now. Let's come back to our Fibonacci ruler. We're going to start right here at the end of the accumulation stage, and we're just going to measure that first one. See how it went up? It went from the bottom up to the top, came right back down, right down into the Fibonacci sweet spot, right down into the delta cone of probability, just like a train on rails. Now the next one, did it do it quite that pretty? Let's come here, up to the top, over. How far did it come down? It came down into the delta cone of probability, but not as low as we would like to have seen. We like to see it come down and hit at least 50. 61.8 is the bottom of the delta cone of probability. Sometimes it comes right back down to there. See, 61.8 over here. It came down pretty low. This is going to hit 50. And then it came down. It went, just barely popped its little head inside the delta cone, and then it turned and started to go back up. But notice that we got these little blue lights. These blue lights are another type of mathematical model that we'll use in lieu of the average true range. So it depends on what indicator you're using. It helps you count your waves. It's just another tool that helps you count your waves. And then we got one more up here that's going up into the third drive. Now you're going to go up here. And this one, of course, once it hits that third drive and we go into the third standard deviation, it came down and it didn't pop back up and go up into a 4th standard deviation. It said, nope, see you later. Down it went. Tumbled all the way down. So if we go down to the bottom of the third drive, it came all the way back down into here. And if we get rid of all these drawings, we'll just use that standard deviation from the very low down here, the bottom of the spring to the very top. the very top of the third drive. You can see where that thing came down. Came right down into this region here. So there's the delta cone is right here, and it blew past that and went down to the next level of 78.6 to match up with this level over here, and then that's where it turned and started to go back up again. So that should be helpful for you. That should be, now you've learned a very important thing about how these markets work. So if we go to the next level, there's drive 1, there's drive 2, there's drive 3. Started to get a little ugly in here. Tried to do a little ABC, went up and matched that top right in there. And then it turned, started to come back down. We have 2 drives down, and then it popped back up, and this is where it just kind of got really ugly. And Amazon just kind of went sideways, not really having any kind of a motion at all. We can use this little Fibonacci tool that we started up with here, and we can kind of use it to give us a projection of where these things are going to go. We might have a little bit more downside potential on this little second drive coming off the top of that little double top up in there. But we've got these little blue dots that haven't been broken yet. We got some previous areas that we need to look at. So down here, right? So if we remember, the market sometimes likes to come all the way back down to the beginning of the previous accumulation zone. So if we look at that, we could say this could be a target for where we might see Amazon coming down into this region here. And then we could start seeing it go sideways, and then that's where we'd see it come back up. So that's how you do technical analysis. You kind of try and read the market by what it's done in the past based on these mathematical models, based on the probabilities of the market, that delta cone of probability, and then you try and anticipate where you think the market's going to go, and you make your decisions based on those assumptions. Let's go look at American Express. Whoa, look at American Express go. Now, this was a lesson that we were doing right here. We could talk about that. This is an options strategy. So you protect yourself to the downside if you think you're going to go long right here. So we got into the market on a break up, but we also said we don't think the market's going to go up. So we're very apathetical to the fact that we thought the market would go up. So we put a put option in here to protect us. It's called a soft stop. Again, we'll talk about that in greater detail in the options class and show you how to protect yourself against that. I'll show you what that's doing right now. I'm not going to go into it in great detail because it's only halfway through the lesson. We'll talk about that lesson in another class. But you can see American Express, we got in right here on the green one in anticipation of the market turning and going back up, right? And so that is losing, that long position of 100 shares is losing $6,400. But we also put in what we call a soft stop, which is an option to protect us in case the market flushes out. And it's up $4,280. So where we're losing $6,000 on one order, where our insurance policy or our protection is up $4,200. So we have a deductible in there of the difference between the $6,000 and the $4,000. That's our deductible on our insurance policy. And so as this market goes, we have what we call convexity, and that will actually go out to eventually a delta of 1.0, which is all the way over here. And those two will match. The only difference will be the difference between the two green lines, which in this case would be here to here, would be about $750. And that's all you would lose, $750. That's your, I mean, it shows more than that right now, but that's because we got time value left. We got a lot of time before that happens. So we can take advantage of that. So when this market turns and stops falling, which it will, it'll come down and it'll start to go sideways and doing all this. You could take your profits from your option, your $4,200, which is going to cover a lot of the downside of this option, this stock. And then the market, once it starts to go back up, well, you're only down 2,000 to make up instead of the entire 6,000. Kind of makes sense, right? And of course, it'll make more if it keeps going down. This number will keep getting higher and higher, and if the further it goes over here, the more that money will make. It'll make more money because the delta will get higher and higher. All right, so that's how that works. We'll play with those again, and that's something you can look forward to learning how to do in the future. But we could do a Fibonacci ruler on that real quick. Let's go throw in here. This is our delta cone of probability, so you can see it in there. Our mathematical model, there's drive 1, drive 2, drive 3, and then it come down A, B, C, just like that. So that's what we're looking at. That's the model that we're building, and that's what we need to learn and understand and apply towards these markets, because they do it all the time. Not every time. They don't do it every time. You know, we saw Amazon didn't do it every time, but they do it all the time. They do it a lot. They do it so often that that's what we need to learn to trade. That's how we need to learn how to do this, because it's all based on probabilities, and it's all based on how the computer programmers who learned this when they were learning how to trade, they programmed this into the system themselves, and that's why these systems do it. It's almost like self-fulfilling prophecy. Let's go look at Boeing. So Boeing came down off the top. Now, sometimes you can turn these things upside down and you get 3 drives down. That works that way too, right? Everything that's bullish can also be bearish. So let's come back to the beginning here of this last trend. So we can see right here on Boeing, we're going to come in, we're going to draw our little trend line all the way from here. This is the accumulation stage. Again, let's just draw it in here with a box. This is our accumulation stage. We got the spring right there where it popped down. That's our very bottom point, and then it turns and starts to go back up. You notice these are moving averages, so they help us identify where the market's in a nice uptrend, breaking out of that accumulation stage right in here. And then this is the moving averages are 100 and 200. So this is a 100 period moving average. This is a 200 period moving average. Again, we'll talk more about those on Wednesday night. But you can see the 3 drive pattern in here one more time. Drive 1, drive 2, drive 3. So we can bring up our Fibonacci ruler, our delta cone of probability. We can go from the bottom here. Let's go from the very bottom all the way up to the top. Now, it didn't come all the way back down off of that. We'll go off of the delta cone. It didn't come all the way back down here into this level. I think if we had gone from the spring, that would have been a little bit too much to ask. Let's see where it went off of. So if we go that, and way up there before it even came in. But let's go right to where it broke those. Let's go right to where it broke those lights right there. Okay, right where that trend started. That's where I put the bottom of the delta cone of probability, right there. So it went up, came down, and it touched it, kind of poked its little head back into the 1 standard deviation, but the market was a little too strong, and it took off and went out from there. So we got our little natural trend line, but you can see the color coding of the market. We use an indicator called the bulls and bears. It comes with track and trade, and it's yellow is neutral, red is bearish, and then yellow is neutral and went green again. So it gives you the first green candle to make a new high right in there, and then took off and went up again. And so you can see that in here, this is our second cone of probability. So we bring our Fibonacci ruler in. We're going to go off the bottom of this one to the top of this one. And it came right back down into the delta cone of probability once again, right there. Just like a train on rails. I'm telling you, it does it all the time. Now it went up here. Now we're getting the little spring up in here. This is the 3rd drive, didn't break the previous high. We're getting a nice little, what we call a wedge pattern. Again, we'll talk about wedge patterns in class on Wednesday night. But you can see it's kind of a little trend line that looks like that. It broke out the bottom, right where those little blue lights are, just like out of the manual that you got. Everybody got the manual. This is in the manual. Okay, so if you got the manual, which if you were in class last night, you should have downloaded the manual. This pattern, all these things that I'm talking about are documented in the manual. And then the market flushed down one more time. So we got this nice little flush down here. It did this little sideways dance through here for a few minutes. And then it broke one more time, and down it flushed one more time, down into the ABC. So that's your ABC pattern. A, B, C, D. Down it came, just like that. All right. And then we got back down into this region here. If we take our Fibonacci ruler, let's get rid of all these drawings. And we just go from this. Let's just go from this bottom here to the top, all the way to the top. Came right back down into the halfway point, right back down into the delta cone of probability, just like out of the manual, just like out of our slides, right? Just like out of our slides, right back down into here, just like that. Came all the way back down from the bottom to the top. That's from the bottom of the 3rd standard deviation to the top of the 3rd standard deviation. Comes right back down to half, 50%, right down into the delta cone of probability again, just like we talked about in class. Just like a train on rails. I don't know if I could lay that over the top. I'm going to see if I can't figure out how to make one that I can lay over the top of the chart. Delta cone. All right, that's it. That's the name of the beast. And then we turned and we started. Oh, what did I just do? Went to another chart. That wasn't what I want to do. There we go. Now we're going to come over here and we're doing it again. Now this market took off like a rocket ship. Holy cow. It just went straight up, broke all the rules. But if we take that Fibonacci ruler and we go in there, that delta Kona probability, and we put that on there, it's coming right back down into the delta Kona probability right there. Just like a train on rails. Whoop. ABC back off the top, right? So we're getting our little ABC pattern. Down one. Get the right tool, land. Get the right tool. So now it's coming down off of here. We're getting down A, B, C, D. So you get your little tool, A, B, C, D. Right down to 100%. Right there's where we expect it to go, right down into here. Now, what's it going to do once it gets down here? Well, we don't know. It could just go sideways, right? Like it most oftentimes does, just kind of wanders around in here for a little while, and then it starts to break out and starts to go back up again. Or it could come down and go all the way back down, do one of these things and come all the way back down and match this level down here, the pre-accumulation, and go into another accumulation down there. Either way, you can add a little bit in here, and then you could put a put option in, protect ourselves like we did over there with Apple, or with with American Express in case it falls. So we get a little insurance policy to help us in case it does fall some more, but we got to keep our positions. And then if it comes down here, we could add in again. And then you could put another put option if you want to. If you think it's going to fall, chance it might keep going down, you put in another put option. But you don't want to keep those put options very long. We want to get a long put option. We buy them for like 100 days, but we only want to keep them for like 30 days. Because then when we can get all the money back, right? You buy insurance, and if you don't use it, you get your premium back. So that's the same with options. You buy your insurance, you might have to pay $2,000 or $3,000 for it, but then you only use it for 30 days instead of 100 days. And then you get all your money back, most of your money back. And then you hopefully don't need it. If you need it, then you cash it in. If you don't need it, you don't. You get your money back. All right, so that's how it works. And then that's what we look for. And that's how we trade. There's Boeing. Now we got indicators down here. We'll talk about those tomorrow night in class. I don't want to belabor the entire issue right now in this class. We'll work on it some more. But here's another. Look at this. This looks like to me an accumulation stage right here. Going through an accumulation stage. Now, again, it's easy to see in hindsight. It's a little bit more difficult to see in the future, but that's why we have the map, and that's why we use the map to help us make our trading decisions. So we kind of map things out. And if it doesn't work out perfectly, well, we've got insurance to protect us. We put another order in there. If it doesn't work out perfectly, well, we've got some insurance to protect us. If it does work out, it's great. Starts to rally, starts to do exactly like the map said. Well, we take the insurance premium off and let the market run. We don't need to be paying for insurance if we don't need it, if the market's going up, doing what we want. So if it follows our map, well, get rid of the insurance policy. If it's not following the map, you got insurance to help you. That's all there is to it. See, it doesn't have to take rocket science. I mean, heck, if I can do it, you can do it. And I'm a little boy from Fillmore, Utah. All right, if I can do it, you can do it. Okay, so here's 3 drives. We actually got 4 drives out of here, didn't we? We got drive 1. We got the counter trend. We got drive 2, got the counter trend. We got drive 3, got a counter trend because it did break the blue lights. It did break the blue lights. So it did come back, not very far, just enough to break the blue lights. And then it went up to a 4th drive. So I'm going to just kind of combine those two and call that the top of the 3rd standard deviation. We could say it went up to 4 standard deviations. You could very easily say that. It doesn't make, it is what it is. It can't, it's not going to follow it exactly every single time. Sometimes it changes things up a little bit just to confuse you. All right, so there we go. Now we got this market's coming back down. It's probably going to make a little ABC pattern in here. And it'll end up probably eventually, my bet is it'll end up down here in the delta Kona probability. That's Caterpillar. And you're like, wow, I really would like to have some Caterpillar. I wish I would have bought Caterpillar down here. But you didn't. Why? Because you don't like to buy things that are doing poorly. You like to buy things that are doing well, because that's a typical retail trader's reaction. We buy all the way up the uptrend and build ourselves an upside down pyramid so that we can get our money all taken away from us when the market flushes out the backside. Because that's how retail traders, 80% of retail traders lose money. So if you can change your thinking and just flip it and say, well, I want to buy low and sell high. Well, when is markets low? Well, we know when markets are low. We may look at the past trend and see when it pulls back against that past movement, and when it gets back down into the Fibonacci sweet spot or down into this region here, this is where we want to be our buyers. We can start buying right up in here. Okay, we can buy in here. Sometimes you notice the market barely comes down, touches that little 38, sticks its little finger, just pokes the Fibonacci sweet spot, and then it takes off and goes back up. If you're aggressive, you can do that. It's up to you. You do whatever you want. This is where you could buy some here, you could buy some more here, you could buy some more here. That's what the big boys do, because they got deep pockets. They buy some more here. Generally, what we do is we wait till it gets down into the what looks like, we try to time it a little bit better. To get down into the accumulation zone, and that's when it breaks out of the accumulation zone. That's where we like to generally, retail traders like to buy. Now, the problem is we just keep buying. We keep buying, and that's where we get in trouble. What we need to do is we need to buy down in here, buy as it's coming down, buy, and then we need to sell all the way up the uptrend like the big boys. Don't keep buying all the way up the uptrend. That turns your pyramid upside down, gives you dollar cost average going the wrong direction. You need to be selling all the way up the uptrend. Try it sometimes. Try it in a demo account. There's CRM. Man, that's an ugly market, isn't it? Ooh, these guys are hurting. You know why these guys are hurting so bad? Salesforce. Because with AI, now you don't need Salesforce. This is what we call SaaS, software as a service, SaaS. Software as a service. All the software as a service industries are flushing out like toilets right now, because you can go into AI and say, hey, build me a Salesforce model. And in about 30 minutes, it'll create one for you, and then you don't need theirs. All right. So we're getting to that point with AI, and that's why a lot of these SaaS companies are starting to really struggle. But a lot of people will still keep their Salesforce, and so everybody's not going to go out and replace their Salesforce with an AI generated version of Salesforce. So it'll probably come back. We'll see the market probably rally back up again. Might be an opportunity for us to get in and watch this thing come back up to the delta cone of probability. It works both ways. It doesn't just come down off the top and go back up. It comes down off the top and goes back up. It might go up and then turn around and come back down. Who knows? But it's probably going to go back to the delta cone of probability. So that's just the nature of the beast. And so you can play those markets and see, well, when it gets back up into there, I'm going to buy down here. See, it broke the little blue lights right there. And that's a good little buy signal right there at the bottom of that thing. Turns around, starts to go back up, gets back up into the delta cone of probability. Might want to take your profits off. That'd just be a little short trade from here to here. Or at least put on a put option to protect yourself, right? You could ride that thing up without any insurance. When it got up there and it gets that little blue light, gets up there and starts to get ready to cross, boom, buy yourself a put option. And then if it does flush down, you got insurance. And then if it turns around, starts to go back up again, it crosses the blue light to the upside again, well, pull off your insurance policy and wait for it to go up and see how far it's going to go before it crosses that blue light again. Put your insurance policy back on. That's what I do. Again, I'm not here to tell you what to do. I'm just telling you what I do. Seems to work pretty well for me. All right, there's Cisco. Cisco's not really very pretty either. We got a couple of these markets that don't follow that trend very well. We got the accumulation stage right in here. And then we got nice little drive 1, drive 2, big counter trend, drive 3. So it's a little harder to read, a little harder to work out. If it's hard to read, don't trade it. There's lots of ones that are easier to trade, but you can see from the bottom of the accumulation stage, drive 1, drive 2. It only went up drive 2, and then this came all the way back down in here, almost like a reset. So then what we do when that happens, we come over and we say, well, let's start over. Okay, let's start over. Get off that auto scale. I don't like that feature. I like to move my charts around too much. So let's come in here and delete all drawing tools, and we'll start our Fibonacci ruler all over again. This is our new delta cone of probability. From bottom to top, it came right back down to dead center into the, well, actually went a little bit lower right there on 61.8. The blue lights are way up here. Where's it going to intercept? Probably somewhere right out in there. If it intercepts right in there, that's what we would expect. Maybe those interception. This would be your interception of the blue light, and maybe the trend right out in here somewhere, and maybe we'll see it go back up from there. Be a good place to maybe put one on if you wanted to. Think that maybe this thing's going to turn and go back up again. If it does, but make sure you put a little put option in there, 100-day put option. Just grab it, stick it right in there to protect you in case this thing flushes down one more time, because you don't want to be caught with your pants down, right? So where'd that saying come from? Just popped right out of my head, just like that. Get caught with your pants down. All right. Chevron. Now, of course, this is all being driven by fear and greed right here for the war, right? Chevron making lots of money because the price of gasoline, crude oil is going up, gasoline price is going up. I don't know. You wouldn't think that higher prices in crude would cause Chevron to go up. They have to pay more for their product that they're buying, but I don't know. It's driving prices up. And there's your drive 1. There's your counter trend. We go drive 2. This is your accumulation stage. So we got 2 drives. We could get a little counter trend, another little third drive up in there. Watch and see. We don't know. You want to kind of a little bit late to the party here for this breakout. Let's wait to see if it doesn't go up and give us just a little wedge pattern right in here. Something like this. Give a couple bars back. And then the first green candle make a new high. Now I got the bulls and bears turned on, so we need to turn off the bulls and bears to get the first green candle. But you got the red candles there. That's the first green candle right there. So you can see the first green candle make a new high. There it is. There's a little pattern we talked about last night in class. Right? I don't need this. Why is this back up here? How did we get that up there? All right, so that's that little first green candle make a new high. There's another one right there. First green candle make a new high. That nice one. There's one right there. First green candle make a new high. Now we haven't got turn on our chart overlay, turn on our ATR. You can see the ATR dots coming up here, but that little first green candle make a new high. That's oftentimes a really good spot to get into the market. Right there, right there. There's another one right there. There's another one right there. Now the problem is you get into some of these, the market gets choppy. Remember, when you're in the accumulation stage, the markets get really choppy and you get lots of first green candles and make a new high that are false breakouts. So you want to make sure you wait for the market to really give a nice little run first. And then it's that's the first place you want to buy right there. That's your little secret strategy. Don't buy through here unless you got deep pockets and you can do a lot of accumulation like the big boys. Then that's a good places to be accumulating. Just keep buying every week. You put a little bit of money in there. That's a great thing to do. And then when it breaks up, this is where most of us get in. We'll put all of our money in right here, put a big chunk of it in right there on that little first green candle. And then as the market comes up, we start to sell out. Sell all the way up to here. And then it gives us another opportunity. We can get back in here. First green candle, get back in here, get a little bit, get back, sell. We get back in here. Sell all the way up the trend. All right, let's go look at Disney. Ooh, Disney's in trouble. Look at those boys. They're having some problems. Let's come back here and see if we can see any kind of structure to this model. You can see some structure back here. Accumulation, drive 1, drive 2, drive 3, ABC retracement. But it kept going. Drive 1, drive 2, drive 3, drive 4, all the way down. All the way back to the accumulation stage. So accumulation here, it came all the way back down into the accumulation again. Broke out the top, went again. Broke out right here out of this accumulation right there. And then rallied up and then drive 1, drive 2, drive 3. Never did give us more than off of the bottom down here. 1, 2, 3, almost 4 drives, right? Don't count that one. So it's just drive 1, drive 2, drive 3. We don't count that spring drive. So that's the accumulation stage. And then you get the first drive out of the bottom. So there's drive 1, drive 2, drive 3. It did it. It's ugly, but it did it. Up a little thing and then flush A, B, C, just like that. The more of them we look at, the more of them you start seeing these, the more of them you can start looking at them yourself. You can start going out and looking at your own charts. It just got ugly in here. This is just ugly. What the heck is this? Right now, we look at that and we say, we're not interested in Disney. We could take our Fibonacci ruler and go from the bottom to the top, and this is where it's coming back through the delta cone of probability. It's kind of getting right back down into here. So if you wanted to start getting into, if you just love Disney and you got to have yourself some Disney, you can start buying some Disney down in here. It's going through a nasty, ugly accumulation on the downside right now. There's some other markets we'd probably like better. But probably in 6 months, or at the end of the year, you'll probably say, why didn't I buy Disney when it was down here at 61.8, right? When it was down in the delta cone of probability. It might come all the way back down to this accumulation down here. We got this accumulation, so don't forget that. But you could get some right in here if you want. If you're really in love with Disney and said, I really believe a big future in Disney. Disney's great, great, great. You could buy some Disney right here, put a put option in to protect you, because it'd probably come down and go through this one here. Nobody knows. It's a carnival game. Goldman Sachs doing the same thing, pulling back, going back down through this. Look at all these. If we just take all these little, there's our first breakout. Let's go look a little bit farther back. Oh, wow. Look at that thing. Beautifully structured. ABC, it's come down here. It's just where you draw from the bottoms to the tops of these things. That one didn't come all the way back down. It just had a real light little break right here, broke the blue lights again, up it went, did the same thing, too strong, really strong mark. Then it went a little, just kind of petered along here. Let's go from here to here. And then it came back right down into the center point. That was tough. Drive 1, drive 2, drive 3. Now we're back in here. Stop auto scaling. So now we're doing this little thing here, this little dance. Put our delta Kona probability on there. It didn't come back. Broke the blue lights, went up again. Then it went up from here. And of course it turned all the way around. So let's go from this accumulation stage here. Let's call that accumulation. We're going to go from the bottom of that accumulation all the way to the top. Now it's coming back down, all the way back down in here. This is Goldman Sachs. So we're getting into an opportunity zone, aren't we? It's coming down. So wait for it. You don't have to wait for it to, you don't have to buy it here. This is called, if you were to buy it right now, this would be called catching a falling knife. We want to wait for that. Now, tomorrow we're going to learn about indicators. So see this big fluffy thing down here at the bottom? We're going to learn how to read that. We're going to include that into our analysis. So then we can start reading mathematical models in addition to our delta Kona probability. So watch for that. Tomorrow night's going to be a really fun class because we're going to learn that. So this is going to come down, and as it comes down, we're going to look for it to stop going up, or stop coming down, right? And what will it look like? Well, it'll probably look something like this. So we'd take that and whatever it looks like here and just imagine it over here. It might happen up here. Depends on how bullish the market is, but we're going to expect it to stop. And how will we know it stopped? Well, that blue light right there. See those blue lights coming down? Those will come down and intercept at some point. And that's where we see that interception, and that's where we kind of anticipate that'll be the end of the accumulation stage, or the drawdown. So we'll get some point out here in time where those two will intercept, and then we'll anticipate a rally. Now it could rally and fall back down again, but could rally and go down and go back up again like that, and that'll be a place for you to buy right in there. See, buy the dips, buy the falls, buy the pullbacks. Oh, I don't want to buy Goldman Sachs now. It's falling. I only want to buy good markets, not bad markets. No, you got to buy bad markets. All right, Home Depot. Another great company, right? Home Depot. Look at that. Beautiful little ABC pattern. So it goes A, B, C. All the way down the bottom. We go through another accumulation stage. Right through here. We broke the blue lights, just like we said. Right there's the blue lights. A, B, C. Doesn't look like it's going to go up and do a third one. We put our delta Kona probability in there. And it's already come back all the way right back down into the one standard deviation right here. So what are we going to do? Well, let's wait for that blue light to come down and that market to start coming back up. And when it intercepts right down in there somewhere, that's where we can anticipate that the market's going to turn and start to go back up again. We can be a buyer. We can put some shares in there, buy right in there. And then we put our little stop order in there. Don't put a hard stop. You could put a soft stop, put a put option right there. Protect you in case it does flush back down, just some insurance. And if the market keeps going up and the blue lights flip over and you start get green, take that insurance policy off. You don't need to pay the whole premium. Get your insurance premium back and away you go. Now you're in a Home Depot. You got a beautiful run back at the bottom, down in an accumulation stage. All right, guys, we're kind of running out of time. That's the whole rest of the market. What I would do if I were you is I would take the rest of the Dow 30 and I'd go down through them. There's Honeywell. Oh my gosh, look at that one. You got to go play with that one. You got IBM. Oh, wow, IBM. Who doesn't love IBM? right? You think IBM's going out of business anytime soon? Probably not. This is your opportunity to buy IBM down at an accumulation stage, right? See how that works? Look at this. Look at this. Look at how structured that thing is. Drive 1, drive 2, drive 3, A, B, C down. Accumulation. Buy again. Go up it goes. It's just how cleaner can it get? That's IBM, about as one of the best, most structured stocks you're going to ever see. Look at this thing went through. That's a little tough right through there. But man, down it comes. Back down into the accumulation stage. Getting ready to cross the blue lights. Down in here. Look at that. What an opportunity. Intel. Structure. Look at the structure on that one. Johnson & Johnson. Look at the amazing structure on that one. Holy cow. Look at the structure. Just draw your little delta cone of probability on every single one of those. Every single one of those little moves in there. Look at where those things come. Man, where's it going to go? Well, we'll probably come back down into here. You buy it again. JP Morgan Chase. Coca-Cola. Woo-hoo-hoo, look at Coca-Cola. That baby ran. It's flushing like a toilet now. Draw your delta cone of probability. Where's it going to come to? Well, we don't know. Probably going to come right back down into here. Might come down into this accumulation zone. Come down there, man. We'd be buying like crazy, right? McDonald's. That's kind of ugly structure. That's not very clean structure. McDonald's is a tough one. Look at all the topping and bottoming whiskers. Topping tails, bottoming tails. All those. We got a lot of them on both sides. That's not good. We don't like to see long topping tails, long bottom. That's lots of. That's you see how hairy they are. Look at how hairy these bars are. That means there's a lot of volatility. You day trade those. All right. 3M. Pretty ugly. Not very good structure on that one. Merck. Oh, look at the structure on that one. Drive 1, drive 2, drive 3, baby. Where are you at? What's going to happen? You can make money when markets fall. Probability of that thing staying up there, 97% chance it ain't going to do it. So it's probably going to come back down into this region here. You could buy a put option and just ride it all the way down. Now, I'll probably go like this. I'll probably do a little of this. Probably do a little of this. Might get some of this. But eventually, it'll probably come back down in here. Who knows? Who knows? But it's going to probably come back to these delta cones of probability, right? We put each one on each one little drive. Go up there. Did this one come back? It came back to 39. It'll go up to that one. It came back. Didn't quite come back in. Oh, it just poked its finger in it. This one just here hasn't poked its finger in it yet. I bet it does. I'll bet it does. Microsoft. Oof. Oof. That's no structure. That thing's in trouble. They're just, big boys are just letting that thing flush like a toilet. They don't care about that market, do they? Back here, we got a little structure coming down. Structure. Nice structure. Beautiful back here. But man alive, did it get ugly out here. NVIDIA. It's getting ugly. I'm really worried about NVIDIA. I got rid of all my long positions in NVIDIA. Procter & Gamble. Whew, look at that. Where's it going to come to? I don't know. Draw your delta cone of probability. It's probably going to come back down to here. That's why we got the word probably. It's the probability. It's probably going to come down here. Does that mean it's going to? No, just means it probably might come down here. Sherwin-Williams. United Health. Whew. That boy, that's USO, that's oil. Visa. Boy, you wanted an opportunity in Visa? I don't want to get in Visa. It's doing poorly. Are you kidding me? How poorly do you think that thing's doing? I don't want to get in Visa. It's doing poorly. Depends on how far back you go to look and decide whether it's doing poorly or not. Verizon. Look at that baby taking off like a rocket ship. What the heck is that? That's probably a bad tick. That's bad data. Walmart. Woo, look at that. Look at that. You trying to tell me you can't see 3-drive pattern in there? You're blind as a bat. Drive 1, drive 2, drive 3. That thing took off out of that little sideways market. just kind of going sideways here, and then it boom, 1, 2, 3, drive your little patterns in there. 1, that thing came right back to 38.2. 2 came right back into the delta cone right at 50. All the way up one more time. Where'd it come back to? Came all the way back down into the delta cone. We're probably going to get an ABC pattern off the top of that one. A, B, it was going to come up and flush back down again. I think we'll see it back down in this region here. That'll be good. Then we'll just wait. What do you wait for? Just wait. Sit on your hands. You don't have to do anything right now. Wait for it to come down one more time. We're going to look for a little ABC pattern, all right? Don't get excited when it comes up here. You get stuck getting in right there and then have it flush on you. You think it's going to, oh, it's going to go again. No, it's gone 3 drives. It's already at the top of the 3rd drive pattern. We don't want to be, doesn't mean it can. It certainly can. Could go 4, could go 5, could go 6, could go 7. Look at this. Drive 1, drive 2, drive 3. Back. Drive 1, drive 2, drive 3. Back. How far is it going to go back? Drive 1, drive 2, drive 3. We don't know. But I'm not going to buy it right there. And not because it can't go up one more drive and go one more drive and go one more. It certainly can. The probabilities are low. I'm too small to buy right there. I don't have enough money. I'm not a big enough trader to buy at a really high probability, low probability point right there. Doesn't mean it can't take off and go again. It certainly can. It's just not for me because I'm not that big. I have to wait for it to pull back A, B, C. I have to see it back here closer to these moving averages before I can afford to get in. That's only, I can't afford to take those chances. Those probabilities are way too low for me, right? So I wait for it to come back here where the probabilities are a little bit better in my favor. And then I have a better chance of catching that rebound and back up. Now, if it doesn't ever come back there, well, I missed my opportunity. It wasn't for me. It wasn't my trade. Go to another one. All right, guys, that's it. That's all I got for you. I'm going to let you go. And if we catch you again, I don't know what I did to make you laugh. Hopefully, at least you're having a good time. All right, so that's all I got for you. And don't forget, one more time here real quick. Let's see. Give you the link to the software in case you want to go get the software and use the software I use.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, go get your software, and then we'll come back. We'll do this again tomorrow afternoon. Tomorrow afternoon, we're going to be using the futures version of the software. We're going to be doing day trading because I like to day trade there because day trading, if you do it in the stock market, requires you to have like $25,000 to trade. If you don't have $25,000 to dedicate to day trading, well, then let's go do it in the futures market out of Chicago. They don't require that $25,000 minimum. We can start with a much smaller account. Start with a couple grand. All right. So we'll do a little day trading tomorrow afternoon at 1 o'clock, and then tomorrow night we'll have our class back at the university at 6 o'clock. So we'll see you then. Take care. Have a good evening. Or have a good, I guess it's morning still. Have a good morning. Have a good day.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.